Welcome to the debate. So, look, last year, a single corporate entity processed $11.9 trillion in transaction volume.
Yeah, trillion with a T.
Trillion, exactly. Just to put that into perspective for a second, if you take the entire gross domestic product of Japan and you add it to the entire GDP of Germany, you still fall short of what this one single network moved.
It's honestly staggering.
Right? And we are not talking about JP Morgan Chase. We're not talking about Visa or, MasterCard. We are talking about Circle, ticker symbol CRCL.
Yeah, it is a volume that completely, it breaks our traditional mental models of what a financial institution actually is, or at least, what it's supposed to be.
Exactly. And that brings us to the crux of our discussion today. It is late April 2026. Circle stock is sitting at exactly $92.55, and the company has arrived at this really profound existential crossroads.
Yeah, Wall Street is entirely fractured on how to model this asset right now.
Totally fractured. Analysts are calling it the $11 trillion question, which is basically, is Circle simply a highly efficient, modern iteration of a traditional bank, or is it fundamentally an AI-native tech startup that has quietly become the back-end infrastructure for an entirely new global economy?
Two very different paths.
Very different. And I am taking the former position. I'll argue for scenario A. My stance is that Circle's core identity and its ultimate destiny is to become a fully regulated, legitimate national digital bank.
Well, then I will be arguing for scenario B. Circle is not a bank. It is fundamentally an infrastructure technology company, like an AI-native startup actively building the payment rails for the machine economy and doing so completely independent of traditional banking paradigms.
Okay, let's look at the reality of scenario A, right? What the bulls are actually calling the golden era.
The golden era, right?
Yeah, Circle is on the precipice of becoming the ultimate modern financial institution. And the catalyst isn't sitting in some, server farm. It is sitting in Washington right now. I'm talking about the Clarity for Payment Stablecoins Act.
Ah, yes. The legislation. Exactly. And for anyone who needs a quick refresher, a stablecoin is basically just a digital asset that is pegged to a traditional currency, like the US dollar. So it doesn't have the crazy volatility of crypto. If Congress pushes this Clarity Act through, Circle transitions overnight from this sort of gray area fintech operator into a federally recognized systemic financial institution.
Yeah, but you're hinging their entire corporate identity on the legislative efficiency of the United States Congress.
Which is, frankly, a terrifying thesis for a company moving trillions of dollars.
Terrifying, maybe. But you accept that legislative friction because the payoff is absolute market dominance. When that federal stamp of approval finally arrives, the compliance floodgates just burst open.
How so?
Well, think about the fiduciary barriers that exist right now. Currently, a portfolio manager at CalPERS, right, or a massive sovereign wealth fund, they cannot heavily allocate to digital infrastructure because the regulatory framework classifies it as too exogenous. It's too risky.
Sure, they have mandates.
Exactly. But with the Clarity Act, Circle's impending USDC Plus product, which is, by the way, essentially a natively yield-bearing digital dollar, gets complete regulatory safety. The fiduciaries are suddenly cleared to enter. And this is exactly why 75% of institutional analysts currently maintain a buy consensus. They're anchoring at $160 bull case target.
Which is massive.
It's a 73% upside unlocked purely by compliance. They aren't competing with decentralized crypto startups anymore. They are systematically going after JP Morgan's deposit base.
I come at it from a different way.
Okay.
Waiting on Washington to validate your business model is a fool's errand. And honestly, Circle's executive team clearly knows this. If the Clarity Act dies in committee or, gets tied up in election year politics, Circle doesn't fail.
You don't think they take a huge hit?
They might take a short-term hit, but they simply pivot to what they internally call the escape velocity plan. They just stop waiting for the legacy banking system to anoint them and lean entirely into the machine economy. You want to talk about volume?
Yeah.
Let's talk about the velocity of that volume. In just the last 9 months, 140 million autonomous AI agent payments were settled via USDC.
Right, 140 million. But look at the actual nominal value of those transactions. I mean, they are incredibly small.
Transaction size is 31 cents. If you try to run a 31-cent transaction through traditional banking rails, say an ACH transfer or a credit card swipe, what happens?
Well, the fees eat it.
Exactly. The clearinghouse fees, the interchange, the network settlement costs, they literally exceed the value of the transaction. The net margin is negative. No human bank on earth can process a 30-cent payment profitably.
True.
But Circle's proprietary Arc blockchain processes these microtransactions for absolutely zero marginal cost. Zero. That completely rewrites the unit economics of global payments.
Look, it is a remarkable piece of software engineering, okay? I don't dispute the technical achievement for a second, but we can't let the elegance of the Arc blockchain distract us from the reality of the balance sheet.
The balance sheet is incredibly strong.
It is, but the Visa for Robots narrative sounds incredible in a venture capital pitch deck. Let's look at the cold, hard math of their current cash flows, right? Right now, $2.75 billion of Circle's annual revenue comes overwhelmingly from Treasury bill interest income.
Yeah, the T-bills.
Right. The mechanics are identical to a bank's net interest margin. They take in user deposits, they park those reserves in short-duration U.S. Treasuries, and they pocket the yield while paying out minimal interest to the end user. I mean, if it walks like a bank, holds reserve ratios like a bank, and makes the lion's share of its money on duration risk and interest margins like a bank, it's a bank.
I'm sorry, but I just don't buy that. Let me tell you why.
Go ahead.
That treasury income you're pointing to as their core strength, it is actually their greatest structural vulnerability. The analysts referred to it as the rate cliff.
The rate cliff.
Yeah, so to break that down simply, Circle is printing cash right now because they are surfing a high interest rate environment. But look at their duration exposure. If the Federal Reserve cuts the overnight rate by just 1% or even 2%, Circle's primary revenue stream compresses instantly.
Well, sure, margins compress when rates drop.
Instantly, though. The rollover yield on those short-term T-bills drops, and their top-line revenue takes a massive, completely uncontrollable hit. That is a glaring concentration risk. It completely undermines the idea that they are some stable, resilient banking giant.
But every commercial bank on earth manages interest rate risk. Managing the spread between your assets and liabilities in a shifting macro environment is the literal definition of the banking business model.
Yes, but the public markets aren't pricing them like a commercial bank. Look at the multiples, man. Circle currently trades at a P to E ratio, price to earnings ratio, of 108.
It's high, yes.
JP Morgan trades at what, 11?
Around there.
Bank of America is at 10. A 108 multiple means institutional investors are pricing in hypergrowth SaaS metrics. They are paying a massive premium for an exponential tech revolution, not a linear banking evolution. If the market truly believed your scenario A, that Circle is just a highly efficient digital shadow of JP Morgan, the stock would crater tomorrow morning to match legacy banking multiples. The market is pricing in the machine economy.
I see why you think that, but let me give you a different perspective. The P to E multiple is entirely justified by the legislative moat I mentioned earlier.
You think a 108 multiple is justified by a pending bill?
Absolutely. Because the structural solution to the very rate cliff you just described is the Clarity Act. Yes, their current net interest margin is highly exposed to the macro whims of the Fed. I concede that. But the Clarity Act legalizes USDC Plus.
Right.
It explicitly allows Circle to act as a central, regulated authority over a vast new ocean of capital, legally sharing that yield with institutional depositors. You really cannot dismiss the domestic U.S. market.
I'm not dismissing it, I'm just...
The liquidity pools managed by American asset managers dwarf the rest of the world combined. Once Circle has that legislative monopoly on the digital dollar, that 108 multiple isn't pricing in software growth. It's pricing in a monopoly premium on the base layer of the internet's money.
Well, you are assuming the U.S. market is the only path to a monopoly. And frankly, I completely dismiss this reliance on domestic U.S. policy.
You can't just ignore the U.S.
Watch me. The global technology growth engine doesn't care about Capitol Hill. If the United States regulatory apparatus doesn't want to facilitate the future, the rest of the world is perfectly happy to absorb that capital. Look at Circle's geographical regulatory arbitrage right now.
You mean Europe?
Exactly. They are already positioned to be the first major stablecoin issuer fully compliant with the European Union's MiCA regulation.
Right, the markets in crypto assets framework. But Europe doesn't have the institutional capital depth of the US. It just doesn't.
It has a comprehensive, legally binding safe harbor covering 27 sovereign nations that provides absolute regulatory clarity today, not in some hypothetical future where Congress miraculously gets its act together. Furthermore, Circle has explicitly established a partnership in Bermuda to serve as an offshore regulatory anchor.
A launch pad?
A global launchpad that is functionally insulated from U.S. domestic law. And while Congress debates definitions, the actual technology adoption is exploding exponentially. AI payments on the ARC network are growing at 98% year over year.
But again, what is the actual commercial value of those payments right now, if it's all microtransactions?
The commercial value is the sheer volume of the microfee model. Think about the underlying mechanics of how AI agents interact today. Right now, a specialized data scraping bot realizes it needs more compute power to finish a task.
Okay.
It autonomously queries an AWS server, negotiates a price for 5 minutes of cloud compute, and pays another bot instantly using a fraction of a USDC token. 10 minutes later, it hires a translation AI, paying it 12 cents for an API call.
And you're saying?
I'm saying there are millions of these microtransactions happening in the dark, every single hour. And every single time an autonomous agent interacts with another agent, Circle takes a microscopic fraction of a cent.
Right.
That is a pure, infinitely scalable software business model. It relies on transaction velocity, not net interest margins. It is entirely insulated from whatever the Fed decides to do with interest rates.
Insulated from the Fed, perhaps. But having laid out these two distinct models, the regulated, monopoly-driven banking titan versus your borderless Visa for robots, we have to grapple with the structural existential threats hanging over both futures.
Oh, absolutely.
Because the risk profiles here are precisely what make this May 2026 inflection point so volatile.
And the risks heavily penalize the traditional banking model. Just look at the analysts at Compass Point. They just issued a firm sell rating with a $55 bear case price target.
That's quite bearish.
That is a near 40% drop from the current valuation. They argue, and honestly, the mechanics back them up, that the traditional banking path is far too fragile for a company priced at a 108 multiple. If the Fed cuts rates, triggering the revenue cliff, and that